Okay, hi everyone, and a very warm welcome. Thank you all for joining us here today. I'm Fiona from Payoneer, and I'll be your host for today's webinar. So, a lot of you guys are here because you're maybe thinking about scaling into the US, or maybe you're already selling there, and you're trying to understand whether setting up a US entity actually makes sense for your business. If that's you, you're in luck today because we have two experts with us to unpack that. So, I'm really excited to introduce our speakers. First, we have David. So David is the head of partnerships at Acclime, and he advises businesses on the practical side of expanding into the US, everything from entity setup to compliance, as well as ops considerations. We're also joined by Jason, who is the CEO of TaxStudio. He specializes very much in US tax advisory, and he'll be covering the tax implications that sellers need to know and understand as they scale. So a quick overview of today's agenda. So David will be taking us through the building blocks of setting up a US entity, including the benefits of registration, various entity structures, how you can choose the right state, as well as ongoing compliance considerations. Jason will then cover the tax side of the equation, including how different structures are treated for tax purposes, federal and state tax considerations, and common compliance issues that you should be aware of. A quick housekeeping before we begin. There is a Q&A box that you see at the bottom of the screen. So please feel free to leave your questions in the Q&A box. And at the end of the webinar, Jason and David will be answering your questions live. So please ask all your questions. And without further ado, over to you, David.
Thank you very much, Fiona, and it's great to be here with you today. I'm coming to you from San Francisco, which was recently voted as the happiest city in the US. You might not know that. It gets a bit of a bad rep in the press. But I moved here 9 years ago from Australia, and I certainly love living here. You probably heard that the cost of living is pretty high in San Francisco, but it's worth it, I think. We have great weather all year round, beautiful parks, amazing coastlines, mountain ranges, redwood forests, wine country, a very diverse population, including a large influence from Asia. We have the world's oldest Chinatown in San Francisco, and great food seen from all over Asia, and a beautiful Japanese garden as well. So if you're considering visiting, please do. And of course, it's also a major business hub with the AI revolution that's currently taking place now, and Silicon Valley being, of course, the investment capital of the world. Now, whether that means that you should be setting up your US business in San Francisco or California is a different matter altogether, and we'll talk a little bit about that today. But I guess we're here today to talk about the US a little bit more broadly, and first consider why the US at all. And as we mentioned, a lot of you are probably maybe already selling here or considering that. And it's probably obvious to most of you on the call that the US remains the world's largest commercial opportunity. For most businesses and most markets, the US remains that sort of holy grail. You will get access to a massive customer base here, investment dollars if that's on your radar, and you'll be able to tap into a scale that you likely won't get anywhere else in the world. And that's because the US economy still, for now, does dwarf anywhere else in the world, including all member states of the EU combined, China, as well as China. So the opportunity is real, and you're here today because you're interested in accessing that market. And the challenge is understanding how to enter the market correctly in the right way. And the key message I want to get across to you up front is that US expansion doesn't need to be complex at the outset. It might feel complex because the US can be pretty daunting when you look at it. It can feel complex because it's effectively 50 countries in one. But most of that only matters once your business starts to scale. Most of that complexity comes in only once you reach sort of a larger scale. Most of our clients take a very simple, low-cost entry approach initially and layer in the complexity once there's real traction and scale in the business. So the first question we ask and look at with our clients is, do they need a US entity at all? Because the answer won't always be yes. Some of you might already be trading from your home country companies, and that might be fine. When we assess whether you need or want a US entity, we usually break it down into two categories. There's hard facts and some soft facts. The hard facts are typically sort of determinative, often tax or compliance-driven reasons. Things like permanent establishment risk or needing a US bank account or regulatory requirements or wanting to ring fence your warranties and liabilities within the US and protect your parent company's assets. The first one that companies often come up against is that permanent establishment risk and wanting to protect you against the risk of your parent company being dragged into the US tax net, which can happen if the IRS is, sort of considers you're carrying on too much of a sort of business activity here. I'm sure Jason can answer questions you have about that later on. But the way you protect against that is to set up a US entity to run your US business instead of your parent entity, therefore keeping things separate. And that separation will also ring fence your US warranties and liabilities, as I mentioned before. The soft facts, in my opinion, often just as important. Customers, suppliers, even employees here in the US, if that's on the cards for you, government agencies, they're just far more comfortable dealing with US entities. Having that structure in place will make things a lot easier. And it also signals that you're serious about the market and not just kicking tires. So once you've determined you need or if you want a US entity, you need to look at you need to sort of think about what type of entity you want. And there's basically two types. There's a C corporation known by the suffix Inc. after its name, or a limited liability company known with the suffix LLC after its name. Now, the main factors that usually drive the choice of entity and the way you structure that entity under your parent company are largely tax driven, and Jason will address those next. However, there are some differences at a corporate and compliance governance level that you can see on the screen here. The main ones come down to how the shareholder holds their interest in the company, because a C corporation has shares. It can have different stock classes of shares, and that is why it's often preferred by investors and third-party investors and especially venture capitalists. Whereas in a limited liability company, it's a more flexible management model, and the members have membership interest that's covered by a membership agreement, and you can sort of keep things a bit more flexible. They both have limited liability protection, and under the C corporation, they have a bit more of a formal governance structure with a board of directors, officers. You have to have meetings sort of on a more stricter basis. Technically, you don't need to have as much of that under a limited liability company, but you're probably going to want to have that because governance matters, especially when you're looking at that limited liability protection. So on paper, LLC sounds a bit more flexible, but in reality, that sort of falls away a little bit from a governance perspective. From a market comfort level, because of the membership interests and the share structure point and that governance issue, people are just sometimes more comfortable dealing with C corporations, especially banks and credit providers, investors, as I mentioned before. So having an LLC can sometimes trigger a few more questions, some counterparty diligence issues along the way. So tax considerations aside for the moment, we often find that LLCs look good on paper and can be useful for early experimentation, but C corps are often better for long-term operations in the US because they're cleaner, more predictable, and easier to scale. The good news is you can switch between them. You can convert an LLC to a C corp. So once you know what entity you're going to have and how you'll be structuring it, you need to decide where you're going to locate your US entity, and that matters quite a bit in the US because, as I mentioned before, you should really think about the US as 50 different jurisdictions, 50 countries in one. The states in the US retain a lot of powers across laws, regulations, and taxation. Now, in terms of operations, if you're going to be physically operating in the US, you should consider what is best for your business in terms of access to employees, to talent, to your customers, to potential investors, to the infrastructure you need to run your business. So be close to that, like wherever it makes sense to have the best outcome for your business. Think about that. But this can, and in most cases probably should, be separated from where you incorporate your entity. Because if you operate in a state, and that's where you have the sort of definition of operating in a state is where you have people, property, product, sometimes it'd be regulatory registrations. Jason will talk about this as well. You generally need to be registered there, and there are tax implications associated with that. So the goal is to be deliberate and to register only where you actually need to operate and then expand gradually as your activity grows. And we generally recommend that Delaware is a good starting point for company and corporations. And you might have heard about Delaware before, and you thought, why Delaware? Why this sort of funny random state in the Northeast? Um, it's known for company and corporations. It's been doing it for the longest. It has the most established corporate law and business court system in the country. They're very efficient at the incorporation process and running corporate filings and things like that. And for that reason, it's sort of generally preferred by investors, lenders, and VCs in the US will typically demand it. They won't really invest in anything else but a Delaware C Corp. There's no state income tax in Delaware if you aren't carrying on a business there, and basically no one does because it's a very small state with very few people. So you pay a nominal franchise tax instead, which is a few $100s a year. So it just provides a good, neutral, cost-effective starting point to base your business from and scale from into other states as and when needed. Because if you're doing business in that other state, you'll need to register that Delaware corporation in the other state. So, for example, if you have employees in New York, you'll need to register your Delaware company in New York. But then if those employees relocate, you'll register the company in the next state that you have employees in, and you can deregister in New York. You're not stuck with a disadvantageous registration in New York that you no longer need. So just quickly onto some little quirks to keep in mind about the US market. Just think carefully about what is legally required or not required here in the US compared to what is practically required to get business done. And what I mean by that, one example we often come across is that there is no legal requirement in the US to have a local resident director like there is in a lot of Asian countries. So that's great. It's a cheaper compliance regime. You don't need to need to have that resident director in place. But in practice, without a signatory on the ground here, without that senior person on the ground to be able to act in that capacity, some things operationally can be harder to do. So on the ground banking at traditional banks can be harder. Tax registrations, counterpart diligence can sort of slow things down. So you might want to think about having that, even though it's not legally required. Be prepared for things to change in the US, be challenged and change again, especially under this current administration. We've seen that obviously with tariffs and the like. It's just something that you have to roll with at the moment. Nothing we can do about it, but that uncertainty is just something we have to live with. Banking with traditional banks in the US can be one of the most frustrating parts of US market entry. You will need a US entity and some level of local on the ground presence to open a US bank account with a traditional brick and mortar bank account here in the US. So definitely make the most of your Payoneer offering because it will make things a lot easier. Now, for most companies, success in the US will ultimately come down to representation on the ground. Now, it does obviously depend on your business model, your go-to-market, your route to market, your go-to-market strategy, your channel to market, etc. But ideally, in most cases, I think it's best done by a founder relocating to the US for at least some period of time so that you can carry that culture from your business, the IP knowledge, and the strategies from your home country directly into the market, and vice versa. You can feed back market intelligence directly into the HQ. But I understand that's a big commitment and not always possible. So obviously local hiring comes into play, but just be careful of that. US labor market is super competitive. It's very expensive, especially in the coastal cities. And people, especially salespeople, are very, very good at overpromising and under-delivering. And so I would just think carefully about getting recommendations from people, referrals from people, rather than just pasting ads in employment notice boards or the online advertisement places, because that can go a long way. If you are looking to relocate here, or if you're spending significant time in the US as a founder with your business, then do take immigration and visas seriously. Especially in the current environment, there's very little room for error on that. So if you're spending significant amount of time in the US, get good immigration advice from an immigration attorney. We can help you with that if you need a recommendation. So let me bring this all together quickly with a real world example. This is an APAC based business, a wellness brand that we were helping expand into the US with. They had strong demand, but no local presence here, no US team on the ground here. The challenge wasn't setting up the entity, that's the easy part. It was operating and scaling in the US while staying compliant, maintaining financial viability, and managing everything from offshore. Our role at Acclime was to act as a long-term operating backbone, handling the entity setup, ongoing compliance, multi-state registrations, and administration, and then the day-to-day finance and reporting as well. As the business grew, we provided consistency, keeping them compliant, and as rules changed, and coordinating across states with the IRS and different time zones involved there. The outcome was a stable, well-managed US operation over multiple years, which allowed the founders to focus on growth rather than the structure and compliance of the business here. And that's really the point. The right US setup should fade into the background as you scale, and this is why the predictability and clean operating structures matter so much for international founders entering the US. And that's what we're here to help you do, is to achieve that. So on that note, I'm happy to answer any questions that you have at the end. Please do, as Vina said, pop them in the Q&A box. And on that note, I'll hand over to Jason to talk tax.
All right. Thank you, David. I feel like you said that so elegantly, and then I'm going to come in and scare everybody here with US tax and compliance obligations. So I got the perhaps benefit of seeing that David was going to talk about the happiest city in the US of San Francisco. So I was able to poke a little fun here because I'm a bit of a tax dork about where I sit, which is in Austin, Texas, and to do a little quick comparison of comparing and contrasting the tax policy or tax posture of doing business in California versus doing business in Texas. So very quickly on the bottom left of the slide that you see here, the corporate tax rate in California is just under 9%. Texas technically doesn't have a corporate tax rate. It has a franchise tax, which tends to be a little bit under 1% of gross margin, typically a far, far less income tax obligation for a company doing business in Texas versus California. Probably one of the biggest things, and David had touched on it a couple slides ago about retaining and attracting talent, is in Texas, the individual tax rate is zero. There's not a income tax imposed at an individual level, where on the California side, it could be as high as 13%. Couple of other points: sales tax pretty much the same, and property tax is actually, unfortunately, quite high here in Texas relative to California. Some other random quick facts about good old US tax. Our tax code is over 6,000 pages long. It has been added and added and added with each new provision, and particularly this last administration has added quite a few more in the last recent year. Another fun fact, which I think we'll probably get to a lot in the Q&A, particularly as it relates to sellers selling inbound into the US, is sales tax is a bit of a beast. There's more than 12,000 jurisdictions within the US in terms of specific rates. So let's jump into the meat of it and move on to the next slide and start talking about tax. I'll quickly cover off this one, and this is really just a bit more of an add-on of what David was referencing earlier. In the US, we have two types of entities that are the common entities to form: the LLC or a C Corp, also known as an Inc. And I want to really emphasize the point here is that the LLC is fiscally transparent for US tax purposes. It itself does not pay income tax. The owners have the obligation to pay and remit the tax associated with the trading or operations of the LLC. A C Corp, however, is opaque. It pays tax at the corporate level. So it's a critical factor to understand as you contemplate doing business in the US. To David's point, an LLC might be a little quicker to form. It might have some simplicity to it, but it might have a very bad income tax answer. And we'll get to a few slides later when we talk about treaty benefits and our US treaty network. Dave, let's jump to the next slide because the topics about Delaware you've already touched on, and the next one's on state income tax. I can cover off into the next slide. So here in the US, our income tax rates, again, have multiple layers of complexity. There's a simple one, that's the federal level. Our federal rate is 21%. It's a flat rate. Doesn't matter how much you earn, flat rate of 21%. Where the complexity comes in is state level, and that state income tax imposition is or can range from 0, as I mentioned earlier, that's for some states, and up to 10%, as California is 8.84. What's important to understand on the state income tax position, David referenced earlier, it's not where you incorporate, it's where you're doing business. And by doing business, the states look at that and say, where are your people? Where are your customers located? And where is the property that you have? So in some sort of making that a little more practical operational points, where are your employees? Where does your customer consume what you're selling? So if you're selling a product, where are you shipping it to? And where is your property located? If you're selling something, where's your inventory? Where's your stock being held? So state income tax planning can matter based off of those 3 fact pattern or those 3 data points relative to your fact pattern. In addition to that, you've got this concept of transfer pricing. Transfer pricing is applicable when you've got your operations in your home country and you set up a US subsidiary. It is, how does your US subsidiary and home country entity interact with each other? They need to interact as if they are unrelated. That relationship really drives the profitability of your US operations. The profitability is what is then subject to US tax at both the federal and then the state level. And some of those key things as to what drives the profitability when you implement a transfer pricing policy is, where's your functions, where's your assets, where are your risks located between the US, home country, or if you're in a larger multi-jurisdictional group, where are they located globally? We can move over to the next slide, David. Sales tax, I suspect here this might be the largest topic or the elephant in the room. So sort of like VAT or GST, sales tax is imposed on a transaction. It should be economically incurred by the end customer. That rate of sales tax, as I mentioned earlier, there are thousands of jurisdictions in the US. And when I say jurisdictions, what I mean is, if we sort of narrow into where David is in San Francisco, the sales tax rate in San Francisco is going to differ from the sales tax rate in San Jose, even though they're merely kilometers away from each other. There are 45 states that impose sales tax. There's a handful that do not. The Alaska, Delaware, Montana, New Hampshire, and Oregon. When you're looking at sales tax, there's 2 questions that you want to ask yourself. And the first one is, do you have physical or economic nexus in a particular state? Physical nexus generally is an easier one to answer. And that goes back to the previous slide and the previous comment of, do you have inventory or stock physically held, even if it's held in a 3PL? Do you have office space? Do you have an employee? That triggers physical presence. And the second one is a more challenging one to maintain, particularly if you're remotely selling into the US, and that's an economic presence. Most states, the economic threshold is 100,000 USD in a trailing 12 months. New York, Texas, California have a higher threshold of 500K. And so you might not have physical presence connected to a state, but if you sell into a state remotely to a dollar amount sufficient, it can trigger the obligation of sales tax. The second question you want to ask yourself is, if the answer to the first one was yes, you either have enough sales or you've got presence in a particular state, the next question is what you are selling subject to sales tax? Think of like a kind of crazy little flow chart. In a general sense, services, what David and I provide to our client base, providing professional services, there's no sales tax, generally speaking. If I were to sell you a pen, which I realize you can't see that with the backdrop right there. If I were to sell a pen, physical, tangible product, it's subject to sales tax. If you are remotely selling a digital product, SaaS, some variation of a technology platform, the answer is that it depends. Some states view it as a pen. Some states view it as what David and I are providing the professional services. So it's a pretty substantial analysis, particularly if you are at that decision making from David's comments earlier that you're not necessarily yet needing to or wanting to set up a US entity, but you're still selling remotely into the US. Sales tax is something that still needs to be considered. Moving to the next slide, David. The treaty network here, I wanted to touch lightly on this point and not get too heavy on it. I realize that most of us here today in the audience are coming from APAC, and it's important to understand that the US has a fairly light treaty network with countries out of Asia Pacific. I've listed them there in the second bullet point. As a result of that, it can change the US tax analysis of whether you should or should not or need a US entity, because there are two critical components of being able to access a treaty network. And it's really the second one that's more important, not necessarily the first one that has to do with withholding tax. But on the second bullet point, there's a higher threshold of doing business in the US before you're subject to US federal income tax if you are selling from a treaty country, or a country in which the US has a treaty with, is a better way of saying it. And so if we were to take two examples and you're selling a product in from Singapore into the US, your threshold of creating a permanent establishment or a US trade or business, domestic terms, is easier to create that problem in the US, which might trigger the need for a US entity, to David's comments earlier, versus let's say that you were coming in from Japan and selling into the US, where you have a little bit more protection because the US and Japan have entered into a double tax agreement. Let's hop to the next one, David. So one thing that I'd like to emphasize, and I suspect there might be some questions here at the end, is when we think about what David and I have talked about we've got 50 states. They don't really talk to each other. They're not very united when it comes to income tax and registrations. It's important to be able to understand or leverage advisors on how to navigate through these compliance issues, particularly for an inbound structure. Inbound structure meaning you're set up shop in home country and you decided to expand into the US. It's a very complex landscape to navigate through. And unfortunately, the penalties associated with compliance is quite high in the US. An example of it is the federal income tax return obligations. If those returns are not timely and accurately filed, regardless of your level of activity, there is a potential penalty of a minimum 25,000 USD per year per filing. So it's really critical on the front end to ensure or understand what your obligations are before embarking onto this adventure of expanding to the US. A couple of other issues that I think are important to understand just from I'll say a tax position or US tax policy that we often encounter after a company is set up here in the US is accrued expenses that have not yet been paid are not currently deductible in the US when it comes to related party transactions. There are some other limitations that can apply on inbound structures. Generally, that threshold is a quite high in terms of total revenue in the group. And as I mentioned earlier, small filings can really, really add up. I use this example a lot in presentations where for for tax compliance, a company that has 50 employees sitting in San Francisco has a much lower overall compliance burden than a company that has 5 employees. But those 5 employees are spread out across the US in 5 different states in a decentralized employment model. The compliance burden and costs associated with the latter, the just 5 employees, is dramatically higher than a centralized one office location in San Francisco. David, next slide, please. So similar to what David referenced, and hopefully being able to tie back to how we, from a tax perspective, integrate within David and the Acclime practice is a little bit of a case study here. We have a client where it's a Singapore headquartered company that's expanded into the US with local manufacturing on site here in the US. It needed to inject capital into the US to help with CapEx spend and to launch the business. The Singapore head office provides management oversight services to the US operations, and the US entity is buying materials and parts from related entities within Asia Pac. There's in this case, about 6 or 7 entities within the structure. The structure we implemented, to David's point earlier, was a Delaware C Corp common structure, helped with the benefits of corporate secretarial and legal purposes. It aligned with tax, and it's going to incorporate in Delaware and then register to do business in which it operates. In this example, it operates in 4 states, predominantly in and around Texas. The issues that we, from a tax perspective, then have overcome with time, call it 1 to 3 years of working with this particular case. We've nailed down the US entity structure. We've worked with Acclime on understanding the employment, where we're going to hire, and then where we're going to file. Working with Singapore Council, understanding transfer pricing. How's the US entity going to interact with Singapore Headco along with the other APAC countries? Really understanding how we can look at the repatriation of profits, dividends. There's a lack of treaty, meaning there's not a treaty between the US and Singapore. And then some just operational tax aspects. Sales tax is a very challenging thing to overcome, and really getting into the weeds of looking at it. And the overall outcome of this, as David alluded to in his case study as well, or similar, is, like this Singapore headquartered business, it's able to expand in the US. It's able to focus on its business while it's partnered with us from a tax perspective, TaxStudio, to handle and manage its compliance and planning obligations. And then, very importantly, working alongside Acclime with all of its corporate secretarial matters, Secretary of State's registrations, et cetera. So with that in mind, that covers my side on the tax side. Again, probably a little bit of a Debbie Downer and Lowell of tax versus David talking about the amazing abilities of growing and expanding your business in the US. But I think we'll open it up now to the Q&A, unless, David, you have anything else to chime in on after the tax components.
No, other than to say that tax is very, very important. So
they're going to make
a
rebuttal back to San Francisco versus Austin.
No. like Austin. Like Austin's fun.
That's true.
All right. There are some questions in the Q&A that we can go through. There's a few we can probably group together. But the
Yeah.
first one we'll start off with. For a seller starting to scale in the US, what's the first signal that it's time to set up an entity? I think we probably addressed this in a few points in the presentation, but from my side, it's usually those hard and soft facts I mentioned at the beginning, and then whenever you're starting to experience some operational friction. So if things in the US are starting to slow you down because you don't have an entity, that's a signal that you should probably start thinking about an entity. So it's not always a clear line. You might need to get a sense of it from your own business and how you're running it. But that's sort of how I think about that. Do you have anything to add on that one, Jason?
No, I completely agree with what you're saying. I would add to that we've seen in practice over the last few years is sales tax compliance can be finicky, tricky as a non-US entity. And so in addition to those like operational frictions that you just mentioned, David, we've seen where one of the few times in life perhaps that the tax tail does wag the business dog. And we say, well, look, if you're registered in 20 states to do sales tax obligations, you might want to have a US entity as your triggering point in order to have, to effectuate those compliance obligations.
Yeah. The next two questions probably grouped together. What are the most common compliance or operational challenges sellers underestimate when entering into the US? And then are there any penalties or compliance issues that can catch sellers off guard if they're not set up properly? Most common compliance operational challenges we sort of see are probably around the state registration points that we touched on. So not fully understanding when you need to be registered to do business in a particular state because either you have people there or stock. That's the main one. So that state level complexity. Ongoing compliance is fairly simple in the US. I mean, there's annual returns and annual filings that need to be made, but they need to be made across all of where you're registered as well as incorporated. So again, you don't want to sort of spread yourself across too many jurisdictions too early for that compliance burden to sort of come too much. You do in the US need a registered agent everywhere you're incorporated and registered. So that's another sort of compliance technicality that you need to have. That's someone who is available during business hours to accept service from government agencies. That's a service that we provide, obviously. They're the main ones. I know that the penalties and compliance on the tax side, as you mentioned, Jason, can be pretty onerous.
Yeah, and I think on this question, I would hopefully summarize this in two main responses. For sales tax, it's important to know that it doesn't matter where you are incorporated or you're formed. A remote seller for sales tax is any company anywhere in the world that remotely sells into a state. So it could be an Indian company, a Japanese, an Australian company. If it's selling remotely into Texas, remotely meaning there's no presence there can trigger an obligation for sales tax. And so I think that's one of these misnomers perhaps of thinking that just because I'm a non-US entity, sales tax doesn't apply, and that's not the case. The second point on income tax is this tricky notion that if you've got physical inventory stock held in the US, you do have an analysis as to whether or not you have physical presence that triggers a US trade or business or taxable presence. And that's my comment earlier of if you're selling or coming from a treaty country, a country which we have a treaty with, there's a higher threshold. You might have a separate disclosure requirement. But if you come from a non-treaty country, say Hong Kong or Singapore, for example, you might have a income tax obligation merely by regularly and continuing to hold stock in the US. And that's probably one of the most common underlooked fact patterns because it's frankly just really easy to do that.
Yeah, great. Next question is from Dina. Registering a company in a particular state, are you eligible to do business in the whole of the US? Well, we discussed the need to register in every state where you are carrying on a business or operating. So yeah, if you incorporate in Delaware, you can carry on a business all around the US, but if you are actively carrying on a business in a state, you also need to register in that state. And as we discussed, actively carrying on a business in the state means having people in that state, property in that state, premises in that state, or having an economic connection to that state, as Jason mentioned. So if you're running your business from outside the US, just with the US company to protect yourself from that permanent establishment, then yes, you can just incorporate it in one location and run your business, but you do need to be careful. Even having stock in a 3PL, as Jason mentioned, can catch you there. If I'm registering an LLC and getting an EIN, it isn't mandatory for me to have an ITIN as well. So yes, when we set up companies and obtain EIN, so EIN for everyone is your federal employer identification number. It's your key number that identifies you with all the US federal agencies. We will organize that for you. You do need someone in the US, someone to be the responsible party with the IRS. The responsible party is someone to receive notices. It's someone on the public record with the IRS. So that person needs to either have a social security number or an ITIN. So when we apply for the EIN for you, we get it really quickly with one of our staff members' social security numbers. But we, at the same time, apply for an ITIN for someone in your company so that we can replace our staff member with your staff member or your person once that ITIN comes through. So yes, someone needs to be listed as the responsible party there. What are some of the upfront typical costs associated with the US incorporation process? It's pretty manageable. I mean, there's no hidden costs of capital requirements or anything like that. There's one-off fees associated with setting up the entity. It includes, as I said, the setting up the entity, all the documents to do so, the EIN, the ITIN, and then if you need to register in states, then there's fees for that as well. I'll put up a QR code in the next slide. If anyone's interested in getting a quote from us, happy to provide that. It'll depend on, as I say, which states you need to, how many states you need to register, etc. There's also some ongoing costs of company secretarial and authorized officer services, the registered agent services in the state you're incorporated in, and every state you're registered in on an annual basis. But that's about it. If you want to do some business licensing searches, we can also do that for you, but that's only really needed if you're usually only needed if you're operating in a particular state, like and registering in that particular state to do business in there. How does Delaware compare with Singapore for a startup that is planning to be eventually acquired? Well,
I can chime in.
yeah.
From a tax perspective, it's a tough one to answer because I would have a lot of questions on who do we expect the acquirer to be and where are the physical operations. So to me, I would say that the operations would dictate more about whether or not it is a Singaporean entity versus a US company.
Exactly. Yeah. I mean, a US buyer is going to be more
Yeah.
he's going to be more used to acquiring Delaware shares. And especially definitely if you're looking for, instead of being acquired, sort of a third party investor coming into your business. That's sort of another way to look at it. But yeah, lots of moving parts into that one. What are the tax complications when hiring a freelancer from a freelancer platform?
Yeah. So I would say two things come to mind. When you hire a freelancer in the US, there's a small thing that they may expect to get a tax form from you at the end of the year, or it's what's referred to as a Form 1099. That's not required when it's a foreign, non-US payor. So there's a little bit of just back and forth with that potential freelancer. The second one is the larger one, which is if you're hiring the person and they're quote unquote in form of freelancer, it's important to analyze whether in substance that individual is truly a dependent agent or could be considered a deemed employee. There are common examples which we sort of tend to follow the Commonwealth here is, does the person have exclusivity with working with you? Are they working full time? Do they have the ability to execute and conclude contracts on and for behalf of the company? These things need to get flushed out in more detail to determine whether or not the company that is engaging with the freelancer in the US might trigger a US tax obligation or a permanent establishment under the treaty words. Really, does it create a US income tax obligation? So it's a tough one to answer in a broad sense. It would very much depend on what is that freelancer doing for the company, duration, etc.
The final question we have in the Q&A. So if you have any more, please do pop them in. Otherwise, I've put up the contact form on the screen there. So please, if you want the slides, you can fill out the contact form and we'll send those over to you. If you have any other questions or you want to get in touch with either Jason or myself, please scan the QR code, send in your details, and we can get back to you. I'll also pop in my email address in the chat, so you can reach me. But Samsul is a seller of gemstones from India. He wants to sell gemstones in the US through an online portal and keep stock here. Again, from India, how can he open a company here? Well, fill out the contact form and contact us. We'll talk you through it, Samsul. But yeah, you can incorporate your entity here, and bear in mind that where you keep your stock here, we'll need to register that entity to do business. And yeah, Jason can advise you on the tax implications of that.
Yep, I would agree.
I'm popping my email address into the chat for everyone.
Looks like we got one more, David, from a Q&A on thoughts on registering subsidiaries versus separate entities in the US, assuming I'm expanding from APAC. Let's see. Thoughts on registering subsidiaries versus separate entities in the US. I'm somewhat extrapolating kind of the more depth in there of there would be separate entities that would be more akin to brother sister with a common owner versus having a holding company that would own subsidiaries. Assuming I'm on the right track with that comment, I would say that we tend to advise or structure where there is a holdco that is holding the US subsidiary or subsidiaries versus it being somewhat of a flat structure that might have common individual owners or non-corporate holdings. Most of that comes around the context of creating potentially treaty network accessibility, simplicity in a corporate form, and usually it involves a potential exit aspects that you're within one consolidated group versus a possibility of having multiple sell and purchase agreements if there's an exit. That's probably a very simplified response to a very in-depth question from the individual, but
yeah, and we definitely see, yeah, far more common at the end of the day to have the subsidiaries under the holding company. I don't
yeah.
see separate holding structures coming in very often at all. Okay, well, I think on that note, I think it looks like we're done with the Q&A. We have a few minutes left if there are any others. Now's the time to pop it in. But once again, contact form up on the screen. Please do reach out if you have any other questions that you would like us to answer. Oh, sorry, I can put that back. Otherwise, it looks like we might be done. Thank you very much for your time, everyone, and thanks to Fiona and the team at Payoneer for having us.